Hello, this is Andrew. In this video, I'm going to talk about a HELOC. What is it, how to use it, and this is just part of an educational series. So if some of this is going to overlap my private lending and partnerships, but this is explaining the HELOC portion of those videos if you want to watch them. So HELOC, it's an acronym. So what does it stand for? We've got Home Equity Line of Credit. So essentially it's two components. We have the home equity and the line of credit. So it operates like an unsecured line of credit or kind of like a credit card, but it's based on the equity that you have in your home. So just a quick explanation of equity. Equity is the difference between what you might have owing on your home and the value of the home itself. So in this example, I'm just going to say $250,000 value of the home. So that would be an appraised value, not like an MLS or a market value, because that's often fueled by emotion and desire. So this is more of a proper professional appraised price. And then your mortgage, for example, you might have $150,000 owing on that $250,000, which means that you have $100,000 of equity in your home. So you can borrow against this amount of money, because essentially if you were to sell your home, that's the amount of money. That is your money, but you can't use it unless you sell your home. So the bank is willing to loan you that money for an interest rate for providing you that service. So HELOC qualifications, you have to have at least 20% equity in your home. Now, that means you have to leave 20% in your home. So that 20% is the bank's security. It's like a buffer. If the market goes up or down, particularly down, then the bank knows that there's still another 20% left in the home, that if they need to somehow recoup their costs, or if you're not paying the loan and they need to take it back, et cetera, that's just a safety buffer from their point. So in order to get any money, you'd need, say, 25 or 30%, depending on the cost of the home. That percent, you need to, say $10,000, $20,000 beyond that to actually start to use it. So your credit score is a factor, just like if you're applying for a mortgage or a credit card. 650 or above, the higher you go, the better interest rate you'll get. So a posted rate online might be sort of the bare minimum. 650 is your minimum qualification, and that's what you might see online. But if you had an 800, you might get a little bit lower. Your debt service ratio, or debt to income, that is your ability to repay the loan. If you have, it's ability to pay the loan because they're anticipating that you use it. And I'll get into the fact that you don't have to use it in a minute. But if you had a car loan, a mortgage, student loan, all of those things add up, and depending on how much money you make would determine how much, or if any, HELOC you could get. It doesn't mean you can or can't. It just may mean that you're not going to get access to the whole amount. And of course, you need proof of insurance as part of that process. So how to use a HELOC? A HELOC is a credit line like any other. You use it like a credit card. You have an available balance of, say, just for round numbers, $50,000. You can use 10,000 of it and pay interest on the 10,000, and the other 40,000 is sitting there ready to deploy. The difference in the HELOC is that because it is secured to your home, it is considered a secured loan versus a personal credit line or a credit card is not secured. So the risk is a little bit higher, so the interest rates are higher. Obviously, a credit card is very high. If you have a personal credit line, you'll know that those range sort of in the high single digits, like a 7, 8, 9%, of course, depending on the time that you're watching this video. So the difference between, say, if it was an 8% for a personal credit line, your HELOC might be 4%. So it's a significant difference. And right now, the higher rates are around 3.5%. So that's really good. You pay interest only on what you use, and you can only pay interest. So it's not like a mortgage where you have to pay interest and principal. You could just pay off the minimum interest amount. Just going back up, the uses like any other credit line. You could use it for consumer products. Potentially, if you're falling behind, you could buy groceries with it. If you had a family vacation you really wanted to do, you could buy that, or a car, or some sort of home remodel. I would be very careful how you use this on a consumer item. If you absolutely need a car and you have no other way of getting it and you can't get to work without it, that might go under emergency, because that's another use for the HELOC. Good for an emergency fund. If you're going to do a renovation on your home, it adds value to the home, so that might be like an okay way to use it, but I wouldn't be buying boats and like all sorts of depreciating assets and consumer type items, because you do owe this money back and you will pay interest on it. And then of course you can also use it to invest. I'm going to go into this a little bit deeper in a minute, but you've probably heard of borrowing against your credit line or getting an RSP loan, because when you put it towards your RSP, you get the rebate back, so that the cost of borrowing the money is actually less than the amount of tax you would have paid. So that's a good use. But you can also invest in things like real estate. As long as you're fairly certain of the return and that the money is going to come back, I wouldn't necessarily just willy-nilly invest in stocks or something like that, because you don't really have control over that. But something that's a little bit more predictable. HELOC amounts. So there's two things to consider. If you have your house paid for and you're just getting a HELOC only, it's 65% of the equity. So in this example here of $250,000, 65% of $250,000 is $162,500. So that is if it's a HELOC only. If you have a mortgage on your property, you can still get a HELOC for the difference between your mortgage and 80% of your equity. So in this case, when you deduct the mortgage out of the total, you come up with 80% of 250,000 is 200,000. So then you subtract the 150 from 200, and that's 50,000. So that's the remaining. That's what you can get in your equity. So you can stack a home equity line of credit on top of a mortgage. Another really good thing to do is a readvanceable mortgage. So if you are going to renew your mortgage at any time in the near future, I would highly recommend that you ask about a readvanceable mortgage. Each bank has their own product, and they have a different name for it. But essentially what it means is you have the value of your home is say $250,000. 80% of that is $200,000. So what they're going to do is they're going to make your mortgage $150,000 and make your credit line $50,000. It's sort of a two-part program. And when you pay off your monthly payments on your mortgage, your credit line will get bigger and bigger. So if you pay down, for example, your mortgage to 125, your HELOC will go up to 75. So you're always at that $200,000 marker, and it's just that one's going down and the other one's getting bigger, but it's still the 80% is still your available borrowing capacity. And of course, as time goes by, 5 years from now, maybe appreciation takes hold and your home is now worth $300,000. So you could go back when your next mortgage refi and say, well, I'd like to reappraise my home and get that boosted, if you so choose. If you're not using the HELOC for anything, maybe you want to leave it alone. But remember, the bank will always give you money when you don't need it. They will not give you money when you do need it. So I recommend getting it while you can. So the pros for a HELOC are you get to use your money and stay in your house. So typically speaking, in order to tap into your home equity, you would have to say sell your house, and then you have to move or downsize to sort of save the difference. In this case, you can borrow and use that money without having to move. If you don't use the funds, you don't pay anything. So don't be afraid of getting a HELOC because you're kind of concerned about how it's going to affect you. If you don't use it, you're not going to pay any interest on it. And of course, it's very low interest. So that is a definite bonus, because next to a mortgage, a HELOC is basically the lowest interest you can have. So now I wanted to, actually I'm going to go back up here as qualifications, broker versus mortgage. If you have a current mortgage, to get a HELOC, it's probably just as advantageous to go back to your bank and ask them. If you have a relationship already. If you don't really have a relationship, I would highly recommend a broker, because a broker can not only broker it with the same bank and maybe get you a better rate because they get bulk discount rates, but also they may find that you could have your mortgage with the one bank and a HELOC with another bank. That depends on the banks, and sometimes one bank doesn't like to have another bank's debt product stacked on top of theirs, just like a first and a second position. So I would recommend a broker in most cases. That's just my opinion, and I can set you up with several different brokers, whichever one you get along with, kind of thing. So the investing portion of using a HELOC, I personally used a HELOC to buy 2 properties, and it's the best decision I ever made. The interest is low. It's easy to pay back. It's easy to control the costs. When you get a chunk of money back from your investment, you just put it back on your HELOC. So I just want to give you an example of private lending with a HELOC. So if you had $100,000 in a HELOC and you were to loan that out privately to fund a real estate project, with me that is, the current highest rate that I've seen is 3.5%. So 3.5%, and that's what you're being charged by the bank. So that equals $300 a month. So that's the first thing that people think of is, I don't want to go into debt to invest or work on a real estate project. Well, everybody does it. All the investors, banks do it, countries do it, super high wealth people do it all the time. It's all about leveraging debt. So if you're being charged 3.5% for the money, then you loan it to me, I would say give you 7% on that money, because I'm just going to be using this money short term, and I can calculate into my my project budget that it's going to cost me 7% to loan that money. And I just pay that back to you monthly or in a balloon payment at the end of my project once I, say, flip and sell a property. So at 7%, I would be, say, giving you back $600 a month or in a bulk payment. So you're pocketing $300. So now you're taking money that you never had in the first place, borrowing it from the bank, paying them their dues. Everybody gets a piece in this. Then you loan it to me. I pay you double that. So you get your $300, the bank gets $300, and I get my money because I couldn't do my project without it. So everybody's happy. Another way that you can invest, again, in my series, I had private cash lending and partnerships. So in a partnership scenario where there is a down payment and rental cost and a mortgage that's needed to buy a long-term hold property, then you can use your money from the HELOC, which is a pretty low interest rate. Generally what I do is I do a process where we can refinance the property within 3 to 6 months. So you really only have to factor in carrying the interest for this property for, say, 3 months, maybe, let's say, on the far side, a year max. So you'd be able to carry that, but you can use the HELOC for the down payment, then qualify for the mortgage separately, and you can also use the HELOC for the renovations cost, knowing that it's only temporary. So those are 2 methods of using it for investing, which of course is what we're talking about here. So I hope that this sort of explains how HELOC works and what the pros and cons, well, there's not really any cons in this scenario, but for investment purpose, this is a very easy, most people have houses and most people have equity in their houses these days. So it's a very easy process. Essentially, you just go to the bank and ask for a HELOC, or as I said, if you can use one of my brokers, and you have to get an appraisal on the house. You're going to have to show ID. You're going to have to show proof of income. They're going to pull a credit score, a credit report. It's pretty painless. Most of it happens behind the scenes, and you just sign some paperwork once you're approved, and then you can use the money as you see fit. So I I hope you enjoyed this, and if you have any further questions, it's Andrew Cox REI. Please look me up, send me a message, and if this is sent to you directly, of course, you have my contact info, and we'll be talking further. So if you're watching this on YouTube and I haven't sent it to you directly, please subscribe and like this if it's been helpful. And until next time, take care, everybody. Bye for now.